All right, so now let me introduce you to our speakers for this fireside chat. First, we have Mr. Sanjeev Mehta, Managing Director, Head Transaction Banking Sales, Corporate, Commercial and Institutional Banking, South Asia for Standard Chartered Bank. Can we have a round of applause? And to moderate this discussion, we have with us Mr. Mohit Gupta, Senior Director of Sales for Dun & Bradstreet, India. Over to you, Mr. Gupta.
Hi, good evening, everyone, and thanks for being out here on a working day. It's my pleasure to host Sanjeev. Sanjeev and me worked together in my last assignment at Standard Chartered Bank, and Sanjeev is a very dear friend, and more importantly, runs a very large portfolio for Standard Chartered Bank on transaction banking, leads South Asia. So thanks, Sanjeev, for joining us here, and today we'll be covering more on the subject which Mr. Das mentioned in terms of the serving the unserved, the credit gap part. So we'll speak more on that. But before I begin and get into the Q&A sort of a mode with you, maybe a few things which are pertinent to note, like India is growing pretty fast everywhere. The noise are pretty positive. If you look at the way Indian economy has grown, we have been growing at a CAGR of 7% for almost last decade. And if you see, we're the fifth largest economy with $3.6 trillion. And with government estimates, we are poised to be the third largest, becoming 5 trillion by 2027. Whether it is 27, 30, that's time only will tell, but that's the forecast. And if you see overall, there's a good noise on India, and Government of India has also taken some good initiatives like GST reforms. And if you would have looked at the January number, it came out at 1,72,000 crores, which is 10% YOY growth. If you look at reforms on RERA, which has been a game changer for the real estate world, the IBC law which came in revived the entire banking sector, and today we're at the lowest when it comes to the delinquency rates in the banking sector as such. And almost the cleanup has been done, which means the banks are well poised to support this sort of the growth in the economy that we are looking at. If you look, many other initiatives in terms of the government of India is doing. But I think and also I think to top it up, which I would also like to mention is, India is now the fifth largest equity market in terms of the market cap. Market cap is close to 4 trillion. And the last report which I read on Jefferies says that we should become $10 trillion by 2030. So everything is looking hunky-dory, and as I think Dr. Singh covered in his presentation, where the bond market is available only to the top 20% of the corporate world, which leads to a very massive situation, which probably we will see as we see while we go forward, is MSMEs, right? Which constitute close to 29% of the Indian economy. And if we don't see the availability of credit to these people, the unserved as such, because there the credit rating may be an issue, the governance may be an issue, that's where I think more work needs to be done, and that's the topic for the day today. And maybe it would be good to chew your brains in terms of your thoughts on it.
So first of all, thank you very much, and thanks Mohit for inviting me here, thanks DNB, but also pardon me for my throat, pretty much, I don't know why, it's not behaving well. Maybe too much of speaking, too much of events like this, but just pardon me. If you have any questions, happy to take it maybe at part of discussion or maybe separately. Okay, so coming back to the point, in fact, what you say, MSMEs, and we've been talking about MSMEs. I heard Dr. Singh, I heard Mr. Das speaking about it. Where do you see the problem? The problem is, it's not that banks, NBFCs, or I would say fintechs don't want to fund them. It's about the way how we are structured as controlled by RBI, directions by RBI, central bank, what and how we can look at a funding or a credit methodology of underwriting standards that we have. Now, while we were saying data is something which is going to be the key for funding, we'll be able to use the data, but we don't have the GST data available for actually being able to do the underwriting.
It's consent based.
Right? It's consent based. Moment you get into consent based, you have an inertia. Moment you get into that, there is that, while you have digitized the entire flow, but it's not automated end to end. Moment you get into those underwriting standards and take that, couple it up to say, can a big, large group, top MNC, fund the deep tier MSME for, let's say, supply chain? It comes in that, boss, sorry, I can't take that risk because I don't know, his balance sheet is not supportive, his data is not coming out to be what I would want it to be, and I can't see visibility in terms of transparency. So if India has to change, and maybe Mr. Das will have to take it back, can we come up with a credit structure which is more dependent on business models, which is more dependent on, I would say, what industry are they supporting, and output driven, rather than, because we all understand all these balance sheets of MSMEs are thanks to, and I'll not say only the CAs, but tax efficiencies that everybody gets it into, are not showing what they're supposed to show, which is the profits or the various numbers. So can that actually be business industry driven? Can that be, how critical is that to the supply chain? Can that be driven by more other fundamental data points, which we take it and the financial institution could just say, just underwrite because it is so important. It's like semiconductors, if they stop, what's going to happen, right? So can those be important, or are these important tools? And then you can underwrite. Probably in my view, that standards has to come out for India, along with financial.
Yeah, I think today, I think a lot of banks actually have digitized their business loans. They have digitized, I think, a lower rung of MSME loans where you just triangulate the data. You take the GST input, you take a bank statement, a bureau report, or maybe an ITR. And it's a engine-driven rule which decides a go or a no-go. But the challenge is every time when you have to take a decision, you need consent on all this, and even if you have to renew, you need a consent. So if, I think, maybe as a banking forum, makes sense if you guys can represent and regulator can allow a one-time consent. So as long as the loan is live, you have the one-time consent. And
also the amounts which are there, sorry I'm cutting you there, but the amounts which these models are underwriting is not exactly what he's looking at. He's like, he needs a bigger amount. He needs to take that giant step forward. That's where, if you want to fund MSMEs, you have to take that leap of faith, which is what I heard somebody saying, very old, 200 years old, the underwriting used to happen on the face. Do I have a face value? I'll get money. If I don't have a face value, I'll not get money, right? So something like that.
So another thing which I know is very close to your heart, Sanjeev, is supply chain, and we did in our earlier days work together on some of the supply chain programs, helping tier 1 suppliers have access to capital. But I think the need is way beyond. Now, how do the tier 2 and the tier 3s of an ecosystem get funded by the institutions? And when I mean institution, they should be from the formal channels. Today, I think many of the fag end of a supply chain is still work on traditional methods of borrowing, right? Do you see, I mean, I'm saying because now it's more closer to you than me, since I changed my field. Do you see that it is getting more acceptability in the fintech or the NBFC world where the tier 2s and tier 3s are also getting access to the formal capital?
Yeah, so good question. So just as a background on what we did together was, probably I can and we can probably claim it was the largest ever underwritten dealer finance program in the market for mobile phone as an industry. So we did it for a client, very large client on tier 1. We took risk at anything like each distributor at a tier 1 level. The risk was about 100 crore plus. And it was in the industry the first that we did. Now, of course, the need at that point in time, which we guys could not address, was can we go to tier 2, can we go to tier 3, which is the retail shops. But you'll be happy to know that we actually are now financing tier 3. So to the retail, the front end retail shop, we have access to them now. We have credit availability. We have our company called Solve, which is a financing a B2B e-commerce portal, where this program is there. And the retail is now being underwritten by not only Standard Chartered as a bank, but it is available as a platform and all the banks can participate and underwrite. So a tier 3 guy, a retail guy of the same mobile phone ecosystem is having access to capital and cheap capital. So which was at about, earlier they were getting at anything between 16 to 24%. Now they have access at about anything between 9 to 12, 13%.
I think it's heartwarming, I think, because if you look at the value chain, the cash flows are well established, right? And today you have means to actually validate those cash flows because if you get the consent, you can pick up the GST statements to validate that. And so you mentioned about Solve, and that's actually what I was alluding to in terms of in your own organization, how do you see or where are you working with the fintechs in terms of addressing this particular gap?
So I've always been of the view that fintechs, while from valuation perspective, I've always got values on B2C businesses. I believe that B2B is where there is revenues to be made for fintechs, or they would be able to extract money from solving for a B2B kind of a business model. We use many fintechs for solving for many problems from receivable to payable. So receivable could very well be maybe a receivable management for a customer who's getting multiple different sources of collections coming in from, let's say, a cash pickup to a check to a digital collection, and making sure that their invoices are reconciled on a real-time basis and the credits get passed out, to also using some of the companies where credit management is underwritten through some of these fintech partnerships. Something that we've seen in the market, and again, what Mr. Das actually spoke about is many companies, sorry Mr. Das, you're leaving, but I'm going to use you to use your name for some of the examples that you actually quoted. What he spoke about is multiple companies today, multiple platforms doing multiple types of problem solving. So, but what companies are looking at it is, I want a single platform where I can use many banks at the back end. But that single platform only speaks to me in a particular format. Okay. So standardization of format is the key thing, which is what some of these, or most of these corporates are now aiming towards. So if that standardization can come in as an industry itself, or from the government-led thing, that's helpful, very good. But if it can't, then of course corporates have to go and choose a partner, which then for banks becomes difficult because you have to integrate with many other partners or fintechs. But that's what we do. We have the largest fintech partnerships across solving for B2B businesses, and that's the way to go forward.
And also, I think somewhere you mentioned transparency is one of the key factors when, which is actually prohibiting access of capital to the larger part of the world. But do you see if data is available to you in a way which can be structured and establish some sorts of connects, or it can help you connect the dots, will that help in terms of credit growth for the country?
Yeah, so that's what we spoke about just about before the event, right? Anybody and everybody who wants to start or wants to grow his business, he will have to go ahead and give credit to the channel. But how much amount of money can he give is the underwriting capability that he needs, and that capability as such is not available to these companies. Yeah. So somebody has to come in and actually give, in my view, has to go a step further. Not only give that particular credit underwriting model, but also kind of take that ownership to say, this is as good as 99.99% your money will come. If that kind of a thing can come out, imagine a situation, an MSME, you underwritten a particular company and you know that, okay, this particular model works and my money is going to come out. Why will I not underwrite them for 1 crore INR versus maybe 5 crore INR, supported by data which is underwritten by companies like you?
So, since I'm aware of this, Sanjeev, I think we did one transaction at StanChart where we enabled the incentivization to become real-time basis for one of the lube companies. And that real-time stuff actually attracts a lot of interest, right? Maybe that's not connected to the topic today, but I would still like that probably you can, for the benefit of the audience, if you can brief a bit on that and probably how these models can be used by the companies to make their channels more attractive, and though it will actually help not on the financial inclusion part, but getting access to the people who are actually very low on the tier, right?
Sure. So, let me give you a background again on what he's referring to. And I can take a name of the company because we have a clearance. So it's Castrol as a company came into us, or rather we went in and spoke to them as to what can we do something leading with digitization as a banker. So there was a problem statement that the finance head was grappling with at that point in time is the plastic bottles of that lube being consumed were all coming back into the factories because these lube bottles carried an incentive for a mechanic who's an influencer in the value chain. So if all of us, if we go to a mechanic to say, okay, put in the engine oil, we get convinced by an influencer, which is that mechanic, to say Castrol ki engine oil is better than maybe some other company there. So the bottle, empty bottle, fetches this incentive, which a mechanic could have gone to a shopkeeper or a dealer distributor, and he would have won a 50 rupee or a 100 rupee depending on whatever that bottle carried. This was never transparent. One, two, he never knew that, the company gave $100, but the dealer distributor was giving him only 50. Plus, also it was prone to, fictitious things coming in. These were all manual coupons pasted on the bottles, and the plastic had to come back to the company. So what we proposed to them was that we will come out with an app which will be used or downloaded by the mechanics. And I don't know most of you, but I remember my initial childhood days that the bottle with the cap being open, we ended up putting in a QR code here. That moment the bottle opens up, the QR code he can scan, and with the incentive payment will be able to trigger money into his bank account. That ended up, bringing three different things. One, definitely financial inclusion, because all these mechanics, what they used to do was this money, when they used to exchange earlier, they used to use it for liquor consumption or maybe tobacco or some other things. With this money going straight into the bank accounts, the money access control was with the families, wives. Wives started keeping this money for kids' education. So 90% of these guys could never get money. It was controlled by the family. The second big thing which happened was Castrol started getting sales data. That okay, this has got sold in a location, and now the trends of that sales data is available to actually underwrite to say, okay, this shop sells 10 bottles of this make or this particular type in this season. So they are able to now use that data back and then underwrite in the market to say, this counter of mine will need 10 bottles. So from a downstream to upstream, they were able to actually calculate what is going to be the requirement in the market in terms of the production that they need to do, and then bring it out in the market in terms of the products availability from logistics standpoint. So it helped them, do about 42% of efficiency. And with efficiency, they ended up doing end-to-end management. And when they launched this, the stock price of the company went up by about 32%. I still remember the day, and we were all cherishing that.
This was the prototype you developed on direct benefit transfer, which got copied by Mr. Modi's government.
No, that's the other way around. In fact,
so I think considering that we're running out of the time, I would really like to thank you for your inputs. And I mean, some of the themes which we talked about, like reaching out to the tier 2 or the tier 3, and digitization, leveraging data, and if some of the data points which can be made without consent, like GST data, I think it will really help bankers to improve their reach and maybe reach out to the people where today you can't take a lot of cognizance of the balance sheets or the P&Ls, right? Thank you for your time, and thanks audience for your patience hearing. In case there is a question, probably we are happy to answer while we network when we are outside. I can see Mr. Mistry out here, so welcome Mr. Mistry to the session. Thank you for coming, and thank you very much, guys.